What if Bretton Woods never collapsed, locking currencies to discipline, reshaping trade balances, flows, inequality, and trust? Permanent fixed exchange rates anchor expectations, reducing speculation and privileging long-term trade over short-term financial gains. Gold convertibility constrains monetary expansion, forcing governments to balance budgets and justify spending through productivity growth. Capital controls remain legitimate tools, slowing hot money and stabilizing domestic investment cycles across economies. Banks prioritize productive lending over currency bets, reshaping incentives toward factories, infrastructure, and skills. Predictable exchange rates stabilize trade contracts, encouraging smaller firms to enter global markets confidently. Developing economies industrialize behind stable currencies, avoiding repeated crises driven by sudden capital reversals. Wealth concentrates slower as financial arbitrage shrinks, narrowing gaps between labor incomes and asset holders. Consistent rules rebuild trust in monetary institutions, reducing political pressure for sudden economic experiments. The dollar remains dominant yet constrained, limiting persistent deficits and externalizing fewer domestic costs. Governments accept slower stimulus responses in exchange for credibility and reduced long-term volatility. Financial innovation evolves cautiously, focusing on risk management instead of leverage multiplication. Currency crises decline in frequency, shortening recessions and protecting employment stability. Multilateral coordination strengthens as rules matter more than unilateral monetary advantage. Corporations plan decades-long investments, confident that currency shocks will not erase margins. Households face steadier prices, rewarding savings and reducing dependence on speculative assets. Technology diffuses through trade productivity rather than financial booms chasing returns. Regulators wield clearer authority since monetary rules limit regulatory arbitrage opportunities. Shadow finance grows slower, constrained by reduced profitability of hidden leverage. Stable growth supports broader middle classes, reinforcing political demand for institutional continuity. Energy markets price risks transparently, avoiding extreme swings amplified by currency speculation. Public debt grows slower, as inflation financing options remain institutionally constrained. Economic culture values patience, planning, and production over rapid speculative enrichment. Income gaps between countries narrow as currency crises stop erasing development gains. Innovation funding favors incremental breakthroughs supported by predictable financial environments. Politics internalizes economic limits, reducing populist cycles driven by monetary volatility. Trade institutions gain authority as stable money underpins enforceable long-term agreements. When shocks occur, coordinated reserves respond without destabilizing exchange expectations. Modern finance remains smaller relative to production, reducing systemic fragility. Digital payments evolve atop stable units, prioritizing efficiency over monetary experimentation. Investors reward durable cash flows, discouraging excessive leverage and short-termism. Cities grow steadily, funded by predictable revenues rather than speculative credit cycles. Education investment remains consistent, compounding human capital across generations. Long horizons enable environmental planning without fear of sudden financial reversals. Supply chains optimize resilience rather than exploiting volatile currency advantages. Speculative capital faces natural ceilings, reducing boom-bust amplification. Money functions as infrastructure, not an instrument of competitive advantage. Societies remember stability as normal, shaping expectations of governments and markets. Entrepreneurs focus on solving problems, not exploiting financial volatility. Finance occupies a supportive role, no longer dominating economic decision-making. Policy credibility compounds, lowering risk premiums across the global economy. Intergenerational planning strengthens as economic rules persist beyond political cycles. This system mirrors debates around digital currencies, regulation, and monetary trust. The present appears calmer, less extreme, and structurally biased towards stability. Flexibility costs emerge, but systemic predictability offsets slower adjustment speeds. Rules shape behavior, and behavior compounds into long-term economic destinies. Continuity proves as powerful as innovation in sustaining shared prosperity. No heroes dominate, only systems quietly guiding incentives and outcomes. The world internalizes money as a shared global public good. Modern debates echo this path whenever stability competes with discretion. Future systems may rediscover these constraints to rebuild trust again. Modern systems quietly trace back to these choices today.